Why capital buffers must be designed for volatility clusters. Capital rarely erodes because of a single price move. It erodes when several stress factors appear at the same time. In digital markets, volatility rarely arrives alone. Price declines often coincide with liquidity withdrawal, collateral repricing, and tightening margin requirements. This phenomenon, known as volatility clustering, defines how risk unfolds in crypto markets. For allocators, capital buffers must be designed for compound stress, not isolated shocks. Volatility rarely moves alone. Historical digital asset drawdowns follow a pattern. Prices fall sharply. Liquidity contracts across venues. Collateral ratios decline. Margin calls accelerate forced selling. At the same time, correlations between assets rise. Portfolios that appeared diversified begin moving together. When volatility clusters, drawdowns accelerate faster than models based on normal conditions would suggest. Layer 1. Price shock buffers. The first layer of protection addresses direct price volatility. Disciplined portfolio construction incorporates conservative position sizing, defined drawdown tolerances, volatility-adjusted exposure limits, scenario modeling across correlated assets. These measures ensure exposure remains manageable even when correlations spike during market stress. Layer 2. Liquidity contraction planning. The second layer accounts for liquidity withdrawal. Order books may thin rapidly. Lending markets tighten credit availability. Withdrawal policies may slow capital movement. Liquidity planning therefore includes mapping venue concentration risk, evaluating redemption windows, assessing stablecoin liquidity pathways, reviewing counterparty withdrawal policies. Liquidity buffers ensure that execution remains possible when markets tighten. Layer 3. Collateral repricing and margin dynamics. Collateral frameworks amplify clustered volatility. When token prices decline, collateral values fall simultaneously. Platforms respond by increasing margin requirements or triggering liquidations. This reflexive loop accelerates market pressure. Capital buffers therefore include over-collateralization thresholds, stable asset reserves for margin calls, reduced leverage during volatile periods, segregated custody arrangements. These mechanisms reduce the probability of forced liquidation. Stable asset liquidity buffers. Stablecoins often function as operational liquidity in digital portfolios. Yet volatility clusters constrain redemption capacity and widen spreads. Maintaining diversified stable asset reserves allows institutions to meet collateral requirements without liquidating volatile positions. These reserves act as operational shock absorbers during stress. Governance and operational buffering. Operational discipline forms the final layer of resilience. Platforms with transparent governance and conservative treasury policies are more likely to withstand volatility clusters. Institutional allocators increasingly examine counterparty capital ratios, liquidity disclosures, balance sheet resilience, leadership incentives, and governance structure. Operational posture often determines whether infrastructure remains stable during volatility. At Kenson Investments, capital buffer architecture is embedded into portfolio governance. Our framework emphasizes conservative exposure calibration, independent custody structures, stable liquidity reserves, counterparty diversification, margin sensitivity modeling. Volatility is structural, not isolated. Liquidity shocks, collateral shifts, and margin pressure often hit together. Preparation preserves capital. Kenson Investments designs layered capital buffers and disciplined risk frameworks for resilient digital asset portfolios. Visit kensoninvestments.com and connect with our team.